You can make $1,000 per month without losing money using this option strategy. This is known as the never lose strategy, making you consistent and reliable income every single month. I personally use this strategy to manage my own portfolio. Please stay until the end of this video to learn how to use this strategy and maximize making profit. So let's get into how exactly we're going to be doing this and what we're going to be doing. So the strategy involves selling both calls and puts to option buyers. These are also known as cash secured puts or covered calls. A very surface level definition is a covered call is getting paid to sell stock at a higher price, and a cash secured put is getting paid to buy stock at a cheaper price. Because of these scenarios, we call this a win-win situation. You're getting paid to sell stock high and buy stock low. Okay, so we know what we're doing now. Now let's get into the details on how exactly to do this. First, you want to start off by selling a cash secured put. Go to a stock and look at the options chain. For this example, we're going to be checking out AMD. Make sure you are on sell and put, and you can choose whatever expiration date you want. Then you want to choose a strike price that you would be comfortable with buying 100 shares at. Let's say we'll be fine holding 100 shares at $62 each, which is $2 under the current stock price. We will select the $62 strike and sell this put, and on Robinhood it will clearly show that it is a short put. Enter the amount of contracts you wish to sell and then enter in the limit price. For this example, we will be selling a $62 strike put expiring in 1 week on November 18th. And for selling this contract, we will receive $164 in premium. This strategy does require a lot of capital. As we can see, we need $6,200 in collateral to open this trade. However, this strategy has a high probability of winning and can prove to be a reliable source of income. There's also a high probability that you'll smash the like button. So how do we win on this trade? So we win if the stock stays above our strike price of $62 at expiration date because it is considered out of the money and the contract will expire worthless. Otherwise, if AMD is below our strike price of $62, then we are obligated to buy 100 shares of stock at $62 each. Regardless, in either scenario, we receive our $164 of premium and we get to keep that no matter what. Later in this video, we will go over some risk management strategies so you don't lose any money. The second way to make money is going to be through covered calls. This strategy assumes that you already own 100 shares of stock, whether you did a cash secured put and you got assigned shares, or if you bought 100 shares of stock outright. So now we want to go to a stock and go to its options chain. For this example, we're going to be checking out AMD again, and we're going to assume that we do have 100 shares of stock to sell a covered call. Make sure you are on sell and call, and you can choose whatever expiration date you want. Choose a strike price that you'll be comfortable selling 100 shares at. Let's say we will be fine selling 100 shares at $68 each, which is currently $4 above the current stock price. We will select the $68 strike and sell this call, and on Robinhood, it will show as a short call. Enter the amount of contracts you wish to sell and then enter in the limit price. For this example, we are selling the 68 strike call expiring in a week on November 18th. And for selling this contract, we will receive a whopping $94 in premium. If AMD is above $68, which is our strike price at our expiration date, then we will have to sell our 100 shares of stock at $68 per share. If AMD is below our strike price of $68, then our contract will expire worthless and we keep our shares. And just like the cash secured put strategy, we keep the premium no matter what in either scenario. In this case, we're keeping $94 of premium. I use both these strategies very often in my own portfolio. So let's get into my own personal strategy. I'll use this strategy on almost any stock I want to own, whether it be a risky growth stock to safe value stocks. My strategy varies based on the type of stock. If a stock is more volatile and risky, such as GameStop, I will sell weekly puts on it at a strike price that is further down because I know the stock moves a lot and I wouldn't want to own shares at an undesirable price. If a stock isn't as volatile, such as Coca-Cola, I will sell puts a few weeks to a month out at a strike price that is closer to the current stock price because I know the stock won't move as much, and if it drops, it has time to recover. In my own portfolio, I sell covered calls on almost every stock that I own 100 shares of. This lets me collect a very sizable income every few weeks due to selling covered calls on all my shares. I tend to hold onto shares that I'm very bullish on in the long term, which is anywhere from 5+ years. So I do sell covered calls on those shares, but I sell them at very high strike prices because I don't want my shares to get called away. By selling these calls, I earn extra income almost every single week, and it's almost like receiving a dividend, but it's a lot higher payment. If I want to own a stock such as Apple that I don't already have in my portfolio, I will sell either an at the money cash secured put, meaning if Apple is at $140, I will sell a $140 strike cash secured put. If I want to purely capitalize on option premium and not own the stock, I will sell a cash secured put at a lower strike price, such as 135 strike. I have a pretty big portfolio size, so I'm able to capitalize on this by selling a lot of option premiums, and by doing this, I'm able to yield in almost $1,000 every single month just by collecting income. Now let's go over some risk management strategies. If you have a cash secured put on, say, American Airlines at the $14 strike, and the stock drops to $13 on the day of expiration, there are some options you have. The first option is the simplest, and it is to buy back the contract at a loss so you don't get assigned shares. The second option would be to roll out the contract to the next week. This means you can place a 2-option order, buying back the contract and then selling a contract on the next week at the same strike or even a lower strike, as long as it nets you a positive premium. Normally, when I roll up the contracts, I can buy back the current contract and then sell a contract the next week at a lower strike price and still receive premium for it. And I can keep rolling out these contracts until it expires worthless if the stock keeps dropping and I don't want to get assigned shares. So you don't really want to use this strategy on stocks that keep dropping, such as Bed Bath & Beyond or Macy's, because there's a high chance that the stock won't recover and you won't make your money back.